welcome to this week's edition of MFB News. I hope everybody's very, very well indeed. The weather's been not bad this weekend, just gone. I hope you got out and enjoyed some real sunshine. It feels like we could be on the last knockings now before we dive into winter. Now, today is Wednesday morning, it's around 7:30, and today is the day of the budget. So what we're not going to be doing is talking too much about the budget in today's video. I know it's a very big thing. I know lots of landlords are holding off making decisions in anticipation of wanting to see what comes out of the budget. But it'd be remiss of me to really talk about thoughts about the budget when actually by the time you receive this video it would have already happened. So what I would encourage you to do if you want to find out more about the budget is have a look at our website. There's going to be lots of articles. We're going to be writing up the budget live as it's happening and then sending it out to you. So if you're receiving this video as part of the weekly update newsletter, there's information on the budget here. If you're watching this video as a subscriber to YouTube, then in that case, if you go to our website, there's a link on the notes below, which will take you to an article outlining all the changes in the budget. Now, we are going to make a nod to the budget in a bit. That's one of the things we're going to be chatting about this morning, is how some of the decisions and news that comes from the budget could influence interest rates. So that's going to be kind of our focus on the budget today. But really, actually, this morning's focus is going to be just about what's been happening with mortgage interest rates in the last week. And then what we're going to do is have a quick dive into where things are currently in terms of pricing and also rental calculations. Okay, so let's first of all talk about swap rates, and no big changes since last week, I'm afraid. So 2 years have floated up ever so slightly, so 3.98. 1 month ago 3.82 and 1 year ago 4.9. So really we're just kind of stuck. I think the budget is going to be really important to kind of reassure or not the capital markets, and hopefully then we might see things start to move. 5 years are at 3.82. Again, much higher than they were maybe a week or so ago, sort of circa 0.3% higher. But actually year on year they're further down, so 4.465 1 year ago. So we're still ahead of the game year on year. Now, in terms of how the kind of increased pricing of swap rates has impacted buy-to-let rates, we've seen a few movements this week, but nothing really major. Again, I think because the pricing hasn't really changed in the capital markets, the lenders are kind of just sitting on their heels. Also, it's half-term week, you know, all those things that kind of go into the mix. So what we have seen is the Leeds increase some of their rates by 0.15. We've seen TMW increase some of their 2-year fixed rates and also withdraw some of their 5-year fixed rates. They haven't actually repriced up, but they've just pulled some of their 5-year rates off the market. Conversely, we have seen NatWest, Foundation Home Loans and Metro Bank make some very, very small reductions downwards, so by 0.1% or thereabouts. Now, why are these guys able to reduce their rates and when others are having to put them up? It's going to be down to a few things here. So first of all, their funding models. So for those lenders who are not very exposed to the capital markets, these guys' cost of funds won't have changed as much as those people who are very reliant on swap rates. Secondly, it could be that their pricing was just a little bit toppy and they've got room to bring things down a bit. But I think the key message here is that those lenders who have made very, very minor reductions in the last week, they're doing so not because they've got kind of, you know, a totally different way of being able to price their mortgages to other lenders. It purely is that they kind of maybe got some room for adjustments. Now, on that note, what I thought would be really useful, because we haven't done this for ages, is a bit of a roundup in terms of where rates are and also rental calculations as well. Now, what I've done is I've taken a average loan amount of £225,000, because that's broadly speaking the average mortgage amount in the UK. And we have, I'm basing it on 75% loan to value borrowing. So 75% loan to value borrowing a loan of £225,000. And what I've done is I've looked at the rates which offer the best value over the 2 or 5 year period. So what I'm doing is I'm factoring in the interest you would pay over, say, 2 years, plus any setup fees. What I'm not giving you is the lowest rate, because what I don't want to do is mislead you in terms of where pricing is. Let's look at the best rate overall rather than just giving you attention-grabbing interest rates, which I know some companies might be more inclined to do. So personal borrowing, 75% loan to value, £225,000 loan amount, 2-year fixed rates, 4.39% with a £2,000 fee. 5 years, 4.59 with a £2,000 fee. And trackers are becoming definitely more interesting at the moment. 5.61% with a £1,499 fee. Now, in terms of rental calculations, there's kind of like the average everybody's using, and then there's kind of like the maximum, and there's loads of different variations in between the two. But actually the average rental calculation, if you're an individual buying a property and you're classed as a high rate taxpayer, so if you take all your top line income, so salaries, gross rents, other income you might receive, if that tips you into the high rate tax band, then you're going to get a calculation which is where you're treated as a high rate taxpayer. Whereas if you were receiving a low amount of money, including all your gross rents and all the rest of it, you would receive a different calculation. So just to keep that in mind, this is why these are never straightforward, but just as a guideline, high rate taxpayer, average rental calculation is 170 times rent, but you can push it up to 226. If you were a basic rate taxpayer, those numbers would be slightly more generous. Limited companies, the same exercise now, 75% loan to value on a mortgage of £225,000, 2-year fixed rates from 5.99% with no fee, 5-year fixed rates from 5.74% with no fee, trackers from 6.24% with a 1.25% fee. In terms of the rental calculations, your average rental calculation for limited companies is currently sitting at around 192 times monthly rent. And for those of you who really need to kind of push things out, you're looking at circa 214 times monthly rent. Okay, now as mentioned earlier, we're not going to go into a whole world of budget on this video, but what we are going to do is just touch on how some of the outcomes from the budget will impact the future of interest rates. And we're seeing a bit actually the kind of concerns the market have with the budget and how it's impacted swap rates because of predictions on what this might do to the Bank of England's ability to reduce interest rates over the next few years. So really just to kind of make you or help you understand how it all hangs together, because it's such a very delicate infrastructure that's kind of sitting around what goes into interest rates. So higher government spending will likely force the Bank of England to slow the pace of interest rate cuts over the coming years. And this is what's been warned by the economists. So Rachel Reeves was hoping to raise £40 billion in her budget today, and this will help fund higher spending on public services. And whilst this will largely come through from higher taxes, alongside these measures, Rachel Reeves is expected to reform the fiscal rules to allow for more government borrowing to fund public investment. Now, economists at Pantheon Macroeconomics have said that the growth depressing impact of higher taxes would likely be roughly cancelled out by the boost of day-to-day spending. They expect Reeves to increase borrowing by an average of £17.2 billion per year over the next 3 years, which will provide a 0.5% boost to GDP in 2025 and 2026. Now, as a result, they estimate the bank rate would have to be 50 basis points higher in 25 and 26 compared to what it would have been under the previous government's fiscal plans. Now, the MPC, and I'm quoting here, can keep cutting interest rates, but Ms Reeves' budget should keep rate setters easing policy only gradually. So their advice is that actually, yes, rates will continue to come down, but it's going to be far more gradual. Now, analysts at another house called Capital Economics agreed that an increase in public investment would complicate life for rate setters at the Bank of England. The direct boost to GDP from a rise in public investment over the next few years would raise demand relative to supply, and this could mean that inflation is a bit higher than otherwise and interest rate cuts happen more slowly. So essentially what everybody is saying here is that actually we can change the way the government can borrow money, which will therefore put more money out for public spending. This will have a boost to GDP, and everyone loves talking about GDP and how we're doing there. So that's kind of a nice headline grabbing thing. But actually the fallout of this means that then Bank of England's rate setters would need to essentially slow down the rate at which base rate is reduced going forwards. Now, just to say that the financial markets have steadily built up bets that rate setters would adopt a more aggressive approach next year as inflation had continued to moderate, as we know, which has been fantastic. But many economists still think the bank's going to take a cautious approach. So really, I just thought it'd be quite useful to understand how the way government spending even can impact what's happening with interest rates, and really kind of go some way to explain to you why we've seen a slight increase in swap rates most recently and why lenders are having to increase their fixed rates despite the fact that inflation's coming down and there's still talk about base rate coming down, even so close as to in November. Goodness me, so all this talk of economics and then a budget today. I think we're going to need a large glass of wine this evening, aren't we, to recover from it all. So look, I'm not actually going to be here next week. I'm going to be having a week off. So I will see you in 2 weeks' time, and then we can discuss the budget. It's going to be, I'm sure, lots of mileage in that one, and we'll be talking about it for a long time to follow. But let's hope that by the time you're watching this, you're thinking that Rachel Reeves actually was relatively kind to us. But for now, if you have any questions, do give us a call, 0345 345 6788. We'd love to have a chat, or have a look at our website, mfbrokers.co.uk, where you'll find lots of information, case studies, calculators, and all the wonderful things that I tell you about every single week. Look after yourselves, guys, and I'll see you next time.